let's get going. Good afternoon. It's Tuesday the 2nd, midday, on the east coast of Australia. So welcome to either this recording or if you're joining us live, welcome. It's been a couple of weeks since our last webinar, and we got such a great response, and there was heaps of questions, and it filled our diaries with new clients and old clients and whatnot. So we thought we'd go through a couple of things today based on sort of what the common questions have been. And given that those questions seem to be very similar, I thought I'd go through what is the transition to retirement strategy that I was referring to in the last webinar, because I said that it doesn't affect any of our clients, what we've been teaching them, and what we'd actually discussed is what those two options are in retirement. It doesn't really matter what these tax reforms are from this current government. So before I do that, for those of you that are new to us or new to me, let me give you a bit of a background on myself and sort of how that fits into the company. And then obviously that gives you a bit of a grounding in terms of what I want to cover with you today, which is strategy. So I started investing in 1996. It started off with my accountant saying to me with my first big tax bill, Jason, it'd be a good idea if you bought one or two properties. That's kind of how it started. I started doing what I've now discovered a lot of people do. I started looking at a 5-kilometre radius where I lived. And I've now discovered that's what nearly everyone does, or where they holiday or where they grew up, areas that you know. And I get it. Obviously you see market changes, you see price changes in those familiar markets to you. So that's what I did for 3 months. And thank goodness I didn't buy anything, because I really had no idea what I was looking for or what I was doing. I went to just heaps and heaps and heaps open for inspections and auctions and everything without having any idea what I was doing. I didn't record anything. I didn't actually make record of when I was going to look at properties as to how big they were, how big the properties were, what condition they were in, sort of what I was looking for, what the rental yields are in the area. I really didn't record anything because I had no idea what I was doing. And then by literally chance, I was at a party and I was introduced via a mutual friend to someone who at the time he was 36 years old and he had 44 properties. And I was like, right, you're my guy. And I begged him pretty much to mentor me. So we ended up having lunch the next day, and we spent a solid 2 weeks with each other, and he invested an enormous amount of time in me. Now, he didn't do it for nothing, so I didn't pay him. But when he asked me a few questions and he realized what I was earning, which meant I had good borrowing power from the bank. So he had a mate who was a doctor, and he had something similar for the doctor that he then included me on. And so he had a particular matrix formula that he used that he later taught me, that we then teach our clients. I'm going to touch on it today, to then narrow down to an area going, right, we need to look for townhouses in this area. This is our price point. They need to be brand new or off the plan. So we're looking for builders, and we would find a builder building 12 townhouses that fit that particular specification. So then we'd sit with the builder and say, right, well, there's 3 of us. We want to buy 2 each today. So we want to buy 6 properties. What's the deal? And so we would negotiate a better deal. And so what you don't want to do in property is negotiate a lower price, because that then impacts upon the valuation of everything else. And certainly the builder doesn't want to do that, because he wants to maximize his value price for the other properties that he sells. So what we negotiated was short settlement. So therefore, if we were buying townhouses for $300,000, which is what we were doing, we would only have to settle on 285, right? Or something like that at the end, which meant that I've automatically got $15,000 equity in that contract price that I could go to the bank and maximize my borrowing against that contract price, and the valuation would actually come in. So I was buying, I bought 10 properties my first year, and I was buying a lot of it without actually having to put a lot of my own money down. I was having to put down deposits, but really, and back in those days, we had really good stamp duty incentives off plan. And so what happened was that my mentor really drilled into me the basics of, you do not predict. We are investing long term. We're going through all of the cycles of the property market and the economy. And if interest rates go up, we've got a strategy, obviously, that's already built in place from the start. That's the reason why we chose those particular properties to start with. Or if there's government tax reform on negative gearing on CGT, then we've already covered that as well, and we're protected too. And so that's what my training was, right, 30 odd years ago, and it's never failed me. And, 30 years on, I've always worked on the worst case scenario of what a government could possibly do within the realms of not collapsing the banking system and therefore collapsing the economy. And it's proven right? And it's really proven right this time round with this latest budget. Every single person I've asked, whether they be an affiliate partner or whether they be a client or whether they be a new client, do you think the government could have pushed this any more ridiculously further? And everyone says no. Everyone says no, this is about as far as they could have pushed it. They've got heaps of pushback. There's already opinion poll that's gone to One Nation. I mean, it's like everyone has agreed this is about as far as a government could push it. And look at all of our clients are actually in the best possible position there could be. So that's how I started. And what I first invested in, the very, very first property I invested in, so this is 1996, and it was a 2-bed, 2-bath, single car space apartment in St Kilda. So back then, I mean, even now, St Kilda is renowned for drugs, street workers, high crime. I mean, it's just renowned for that. 1996, it was even more rife, right? It was really bad. There was lots of drunk people on the streets. And it was pretty bad from a demographic point of view. I mean, my girlfriend lived in Blessington Street in St Kilda at one point, and when I spoke to the police when they found a dead body in the back laneway, they said, yeah, there's pretty much a toll that they have every year for what's obviously dumped in the area. So it wasn't really renowned as obviously being a good area. And here's me buying my very, very first property there. So. But what I've been taught is that the area, you can't be that close to the CBD and there and be surrounded by blue chip suburbs without that area heavily gentrifying and obviously shifting, because it has the most amount of capital growth to shift and also rental yield to shift. And by the way, he was right. He was absolutely right many times over. Now, when I had my first meeting with my accountant, he freaked out. Now, you got to remember, this is the person that told me I should go and buy 1 or 2 properties. So here's me. I bought my first property. I've got a really good deal. I've been educated really well by someone who is very successful in this space. And my accountant got very excited about all the numbers and worked out all the taxation and everything on it because I had my depreciation schedule, etc. And then when my accountant saw where it was, he freaked out. He said, St Kilda, oh my God, what are you doing investing in there for? And proceeded to give me this massive lecture. So for 45 minutes, I felt about that big. I went in there feeling really good about myself. And then within 45 minutes, I've got my accountant literally grilling me about, oh my God, what have I done? And I'm thinking, oh, what a disaster. But then I started to think to myself, hang on a minute. I'm taking advice from a guy who's just bought his 46th property. And now I'm listening to Max, my accountant. I said, Max, how many properties have you got? And it turned out he didn't have any investment properties except for the office that he just bought for his little practice. And he's paying off his house. And I said, with all due respect, Max, I'm taking advice from a guy who's just bought his 46th property. He's taught me X, Y, and Z. And for the meantime, I'm going to take that advice and you do my tax. And then I spoke to my broker. My broker was telling me about how I could maximize me getting a better interest rate and to lower my credit card limits. Because as you know, the high limits on your credit cards can actually affect the investment debt that you get. So I got advice on my loans from my broker, but again, I didn't take advice on where I invest from my broker, or my accountant, or as it turned out, my conveyancer, who's a lawyer, who also gave me his 2 bobs worth. So I pretty much got 3 different opinions aside from my mentor. And in the end, I listened to my mentor. Thank goodness I did, because it was enormously successful. And what he taught me was this: Jason, we don't predict. We're not trying to look in for the low part of the market and get out when it's high. We're not trading here. We're playing the long game. We're playing the get rich slow game. And where did I get that terminology from? I got it from Warren Buffett. So there's a very famous book that Tony Robbins wrote a few years ago where he wrote it based on investment mastery. And he interviewed all these very, very successful investors. And one of them was Warren Buffett. And after Warren Buffett had told Tony Robbins what his strategy was, which was, over a long period of time, there'll be a certain amount of growths in the stock market. There'll be a certain amount of crashes, but the net gain over time is always higher. So whether you invest at the peak of the last peak of the market, if that's where you start, or you invest at a trough, it doesn't really matter, because when you're investing long, you're obviously getting those inflections. So there could be 3 or 4 or 8 growth phases in that time. And Tony Robbins said, geez, it's so simple. Why doesn't everyone do this? And Warren Buffett said, because not everyone wants to get rich slow. And that's the key, right? So that is very much the guiding light for me, for everything that I've taught my clients over my whole career, and obviously what we teach at Property Investors. And so given that that's the case, what we want to do then is maximize our capital growth, because that's where we create our wealth, is in the capital growth over time. Okay, so the whole idea here is that you've got 15 years or 20 years or 25 years or maybe even 30 years until you obviously hang your hat up and retire. And in that time, if you're working and paying tax, you continue to expand. You're able to get investment debt. That investment debt is obviously tax beneficial, and you keep expanding with your portfolio until the day that you retire. And then at retire, we have a transition to retirement strategy, which I want to touch on today. So we maximize our capital growth. That's the wealth. We maximize our cash flow. So it's the cash flow that allows us to go so long. If we didn't have strong cash flow, then you'd have to bail out of the market at different stages because interest rates go up and you have to bail out. And so that's why in the period that we had after the global financial crisis, when all the interest rates came down with monetary policy and fiscal policy, the government started spending obviously money too. So with obviously government spending and interest rate control, there was a lot of activity in the property market. The property market boomed really hard and the interest rates were enormously low. I mean, some interest rates had a 1 in front, most of them had 2 in front. And from my perspective in this industry, it was enormously frustrating because every single person I spoke to was an expert all of a sudden. It's pretty easy to be an expert when the market's booming, the cost of money's low. But I was looking at people's choices of their investments, of what they were about to invest in, what they had invested in. And they would ask me what I think. And I would say, well, you haven't really thought about what would happen when interest rates go up, or what happens if there's tax reform. You haven't really thought about that. What's the goal here? What's your strategy? And they didn't have one. They were going out and buying opportunities with the opportunity of cheap money. And so when interest rates started to go up, and here's the thing, right? If we're talking prediction, and if you think, you know, I'm really good at prediction, or anyone else is, none of us are good at prediction. I mean, interest rates came down to 2%-ish over what, 12 years? And then finished in a pandemic where the government overspend, inflation goes up and they have to increase interest rates. Now, I didn't predict that. I don't know anyone that predicted that. And I'm sure you guys didn't predict that either. So to say that, oh, I predict that the market's really low now and it's going to increase, what a load of crap. We can't predict that. So the reality is that all of my conversations I had with people when the interest rates were low and the market was booming is that at some point the interest rates are going to go up. I don't know when that is, but they will go up at some point, as they always have, as the cycle always proves itself. And so when the inflation went up because of government spending with COVID, interest rates started to go up. And then all of a sudden I had back-to-back record years. I've never had my phone ring so much with people that I'd spoken to over the 12 years prior, where I'd actually said to them, you wait till interest rates go up and you'll realize the property you've invested in or the property you're considering investing in. Now, some of those people that called me were my existing clients who wanted to benefit more from it because my credibility went up a notch or two. But with everyone else, my credibility went up as well because I'd actually warned them what would happen when interest rates go up, and then they realized the error of their ways. So then they came to me much more open to actually heed the guidance of a long-term strategy where the strategy includes interest rates are higher, interest rates are low, or government tax reform. And so that's what I've always taught people my whole career, because that's what I was taught. By the way, that mentor of mine, he's now a billionaire venture capitalist in the US. So it's not like I took advice from a dumb guy, right? He was very smart and he taught me very basic formulas. So when you invest and you're investing get rich slow, you want to maximize capital growth because that's your wealth. You want to maximize cash flow because that's how you get there. And cash flow includes interest rate rises, right? Cash flow includes if there's tax reform. And also we want to minimize or contain risk. And most risk is actually associated with cash flow, right? So therefore, we want to make sure that, well, what happens if you lose your job or if you lose your business or if you lose your form of income? What then? How do we maximize your rental income and minimize your rental vacancy? And so everything that I was taught that I then have subsequently taught to clients has been about those three things: maximize capital growth, maximize cash flow, minimize risk. And so what's the worst possible thing that the government could do, right, in terms of changing government policy on negative gearing, which in 1985 they axed negative gearing under the premise that it supports wealthy, which it does not. Negative gearing does not support wealthy. It supports the battler. It supports the mid to low income earners. Wealthy people, in my experience, put more money into the deal. They have a lower loan to value ratio and they have positive gearing, not negative gearing. So it was crap that they actually taught the Australian public that, because they just wanted to tax reform to actually have less government spending on building on obviously negative gearing. So they axed it in 1985 under a Labor government, Bob Hawke, Paul Keating. Within 2 years, exactly 2 years later, in 1987, they had to reinstate it because rent spiked. Because the whole purpose of negative gearing when it was introduced early last century was to encourage people to invest, to provide more supply of properties to be rented, to then keep rents at a controllable price. And they were properties that the government didn't have to build. So it's a darn sight cheaper for the government to give an incentive with negative gearing than it is for them to actually have to build the property at all. And so that's why it was introduced, and that's why it's been an age-long thing. 2008, Julia Gillard spoke about it again, and it was fortunately killed off by the opposition leader at the time, which is Malcolm Turnbull. All right, now, fast track to now. So the government had done it. Everyone I've spoken to have said, look, could the government have pushed it any further? No. The amount of kickback and force back that they've had, and CGT, I mean, it's impacting upon entrepreneurs where they've got startups and they're looking to do an exit and they've got massive CGT issues now. I mean, you couldn't get bigger pushback. And look at the One Nation approval rating now. I mean, it's just obviously it couldn't have been any bigger pushback. So therefore, this is about as far as it's going to go. And as a result of it, our clients are all better off. They're not only not affected by it, but they're going to be better off because it's in the markets they've invested in that are actually all going to grow. And it's in the markets where people didn't take our advice and went to regional areas on established properties with higher yields that they're all going to suffer. So, yet again, it's proven, and that's why I'm going to beat my chest right now, because we have clients in far better positions than anyone else that's obviously taken advice in this space. And it's been based on the fact that we've just always stuck to our guns. We stuck to our guns during COVID. I mean, we'd never been through a pandemic before. Everyone was full of fear, but we still stuck to the same formula. So to maximize capital growth, maximize cash flow, minimize risk, here's the three pillars. We go to an area that has minimum 4% yield. We go to an area that has the most amount of gentrification in Australia. And the area has to obviously the properties have to be brand new. So if there's the most amount of gentrification, that means that the area is being flooded with young working people and the population growth is going up in that area. And therefore, construction of houses, townhouses, or apartments have to meet that level of demand. So therefore, everything is brand new to meet the demand by the sheer nature of that formula. Then everything is brand new. And so therefore, the maximized tax benefits for the actual cash flow, but then you obviously have this disparity between demand and supply. So in the whole of Australia, COVID closed international borders. We were like, well, there's only one area in Australia that's properly gentrifying, and that's Southeast Queensland. So that's where we went in 2020. We sourced all of our houses, townhouses, and apartments from there. Everything doubled in 2 to 3 years. A lot of people said, oh my God, how did you predict that? We didn't predict it. We just kept following the same formula. So when people say, what's your prediction? Don't ask me. I don't have a prediction because everyone's predictions are usually wrong anyway. We have a strategic long-term formula that minimizes risk exposed to government reform of tax strategy, and that obviously also minimizes the risk if you lose your job, that also minimizes the risk if there's increasing interest rates. So as a result of that, we've had nothing but success with our clients. All of the 6,000-ish properties that our clients have invested in, they're all going through capital growth. They're all cash flow positive. It does everything run perfectly? No, of course not, right? It doesn't always run perfectly. But the point is that from an overall standpoint, everyone is winning, right? So, for example, after COVID, there was a post-COVID hangover in WA, and we were there. We were there sourcing houses, And initially people were buying 5-bedroom houses for high fives, right? 580, 590,000, and then into the 600s and 650s and high sixes, and then into the 700s. And a lot of the valuations are coming in now with 8s in front, 9s in front. So everyone's done exceptionally well. Now, were there hiccups in construction? Did it take longer? Were there hiccups with communication from them? Of course there were, right? I'm not saying there weren't issues, but the net position that everyone ended up in was a win. And now they're also winning with the rentals, right, as well. So nothing ever goes exactly to plan, especially in the property space. But we're looking at long-term investing, and we're looking at what possibly could change in that long term. Could you lose your job? Could interest rates go up, or could they go down? And could the government reform? Right. And so when we looked at tax reform, we looked at negative gearing. And given that what they did in 1985 to 1987, it's pretty safe to say they're not going to do that again. So therefore, negative gearing would almost always have to, if they reform it, and the reform, if they try and grandfather it, that would be a disaster. That would collapse the market. Then we'd have a screaming banking sector, and then the banks would be too exposed. So a government's not going to do that. No matter how dumb the government is, it's going to get all sorts of pushback from the private sector. So they're not going to do it. And so they also need to support the construction industry because it's such a massive employer, and especially for a Labor government. Because a Liberal government is not going to make these types of tax reform changes. They'll make other types of changes with their policies. So I'm not saying one's better than another. It's just that it's more likely to happen under a Labor government that they actually affect this change. So why would they then put tradesmen out of work in the construction factor if they then grandfather negative gearing across all properties? And so that's why, lo and behold, the biggest change that they could ever make, they retain new properties. So therefore, those properties straight away have all not only retained value, all the developers and all the builders in that space are already starting to increase their pricing already. All right, so we've already got opportunities right now. We're on the 200 or 300 properties on our list. We've got those prices frozen from our developers and builders while they're now increasing pricing for anyone outside of our organisation. So that's already created opportunities for our clients and for our new clients. So that's why we're beating our chest. That's why we're saying, well, look, we've done it again. The guidance that we've given our clients was the right guidance. Every one of our clients is in pole position, and there's nothing but wins that actually come from this for our client base. But there's going to be, unfortunately, a whole lot of losers for people that didn't actually either take that advice or didn't know about our advice in the first place. And so that's why when interest rates are low and the market's booming, it's very frustrating for someone like me, because it's like that people don't know what they don't know. They just get caught up in the greed. And as Warren Buffett says, be fearful when others are greedy. But when others are fearful, and there's plenty of those people now, be greedy. So now's the time to be greedy, because there's all sorts of opportunities that come as long as we've got the right strategy. And so that's why in a 6-step process that we have, we educate our clients over time so that when there is tax reform like we've just had, and when there is increases in interest rates like we have had, we don't get our clients flooding us with all sorts of fear, right, about what's going to happen, because we've educated them. Right, and they understand very clearly where the position they're in when there's those sorts of changes to government, tax reform, or when there's increases in interest rates, or if they lose their job, for example. We just don't get flooded with calls from our clients. If anything, we get flooded from our clients saying there's got to be now opportunities, Jason, because we learnt from this last time when there was COVID. We learnt from this last time when interest rates went up, because all we saw was opportunities that came as a result of those sorts of impacts upon the market. When other people are full of fear, all of a sudden our clients get to benefit from that. All right, so that's the main message I want to convey to you guys today, is that there's opportunities that come from there. Now let's look at the transition to retirement strategy. There's 2 main ways to retire with assets when you retire. So if you're going through the next 20 years or 15 years or 25 years, and you're expanding your portfolio whilst you're earning money and paying tax, and therefore can keep getting investment debt over time, you expand your portfolio and pay off your mortgage. So your mortgage on your home's got to be eliminated ASAP, because that's the single biggest source of financial risk, bar none. So now you end up, you want to retire and you've got multiple properties, interest only loans. So the loans haven't been paid off. There's no way you can pay off loans on multiple properties after you've paid off your home loan. It's just not possible. The numbers don't add up. Mathematically, it just doesn't add up. So you're going to end up with multiple properties with interest only loans, the values being whatever they are. So there's going to be a spread in your equity. How do you retire on those? And in my experience, most people haven't thought about that. There's two main ways to do it. You either keep refinancing those properties over time and you live on the redraws, right? That's what most wealthy, very, very wealthy people do. So Elon Musk pays himself whatever, $1, right? Like Steve Jobs when he was alive, he paid himself $1. They have all of their assets in all of their shares, massive share value. So, Musk has obviously got Tesla and X and so on, right? And so there's lending institutions that are falling over themselves to actually loan money to these guys. And so what they do is they use those assets as security to borrow against, and they live on the borrowed money tax-free. All right. You can absolutely do that going into retirement. It may not be borrowing with Commonwealth Australia Bank, but there'll be lending institutions that'll lend money just based on the rent, because the rent will have grown, the value will have grown. The debt hasn't been paid down, but the loan to value ratio has gone down, right? Because the value's gone up. So that's option one. Now, in my experience, most of our clients don't like that strategy because they just don't like the whole idea of having debt in retirement. No problem. So therefore, what it means is that we can consolidate by selling one or two properties and then consolidating the debt on the ones you've got left. And now you've got wholly owned properties and you can live off that rental income. That's when then people said, oh, but they'll pay the double the capital gains tax that I was paying before. It's like, well, you're still going to pay a lot of capital gains tax. So therefore, we educated our clients, it's not a good idea to sell those properties that you're going to get capital gains tax on. Even back then, there was a 50% discount on it. Still not a good strategy. What would be better is to sell the one or two that are in your self-managed super fund and not pay capital gains tax on them. That property also, you had a P&I loan that you're paying off over time, so you've got a much bigger spread in equity that you can then settle the debt on the other ones. So which one is best for you? You're not going to know that until you get close to retirement, but we can structure our clients in a way that give you those options. But either way, the guidance that we gave our clients are still excluded from being affected by the capital gain tax reform and also by the negative gearing reform. And they're now going to actually be in markets that are going to grow, and they're not in the markets that are actually going to contract or going to flatten out now. All right, so we're pretty proud of that. None of it's surprising to us. We didn't have to pivot. We're just business as usual. We just keep doing what we've been doing all of this time, and I'll just keep teaching my clients the way that I've been teaching them for 30 odd years. But now we've got more pairs of ears ready to listen. All right, you guys have a great day. Reach out to your agent, right? Reach out to your consultant. Otherwise, just reach out to us in general. Let's sit down and review your strategy, because there are opportunities now that there just weren't before. All right. And this is the time where we're very, very busy, because all of a sudden everyone's starting to really realize the value of obviously what we offer. And you don't even pay for it. We just make our money out of the real estate commission that was already budgeted for by the vendor anyway. That has to come into the valuation that they get so that the bank can settle on the property. So it doesn't cost you anything to deal with us, but we offer a very, very specific service and guidance and education, where we now have over 2,600 clients that have invested in 6,000 properties that are all growing and they're cash flow positive. All right, so I think we might do these webinars maybe every 2 weeks. Give some feedback to your consultant about what you would like, but at least monthly. Let's just see how this progresses, because I know that for myself, my diary is obviously very, very full after these webinars. And there's obviously a lot of people now starting to realize that having guidance and strategic direction from us is very, very worthwhile once they start to see a change in interest rates or their own income or now tax reform. Have a good afternoon, everybody. We'll see you in a few weeks.